AI data centers were supposed to be the safest way to play the AI boom. Then the Neoclouds crashed. CoreWeave dropped. Nebius pulled back. IREN spiked, then wobbled. Behind that volatility is a brand new business model that Wall Street still doesn't fully understand. Are these companies the picks and shovels of the AI gold rush, or just overleveraged landlords with fancy GPUs? Today we'll break down the Neocloud crash and ask one question. Which Neocloud actually survives the next 5 to 10 years? CoreWeave, Nebius, or IREN? Let's get into it. First, what exactly is a Neocloud? It's not a classic hyperscaler like Microsoft Azure, Google Cloud, or Amazon Web Services. Instead, think of Neoclouds as specialized AI landlords. They secure land and cheap power. They spend billions on Nvidia GPUs and data centers, and then they rent that compute to whoever needs AI capacity the most. A lot of them started life as Bitcoin miners. Mining got tougher, margins shrank, but they were already good at buying power, building data centers, and running intensive workloads. So they pivoted from mining Bitcoin to hosting AI workloads. Same infrastructure DNA, completely different customers and contract structures. If Microsoft, Google, and Amazon are so huge, why do they even need Neoclouds? The answer is simple. AI demand is growing faster than construction timelines. Training and serving big AI models requires massive GPU clusters, huge amounts of electricity, and billions in upfront capex. Even megacaps can't spin up that capacity overnight. Neoclouds stepped in as flexible shock absorbers. They take on the power contracts and data center builds, and hyperscalers and AI labs sign multi-year capacity deals with them. That's how companies you barely heard of a few years ago are now announcing $10+ billion contracts and multi-gigawatt power pipelines. On the surface, the Neocloud business model looks incredible. Step 1. Lock in multi-year contracts with blue-chip customers. Step 2. Show a huge backlog and triple-digit revenue growth. Step 3. Pitch yourself as the AI infrastructure toll road. But under the hood, it's very different from software. They must spend billions up front on GPUs, power, and buildings. They usually finance that with a lot of debt. New sites can take years to go from planned to revenue generating. So the equity investor sits on top of construction risk, interest rate risk, and customer concentration risk. When everything is going perfectly, that leverage amplifies returns. When something slips, a delayed project, a weaker contract, or tighter credit, that same leverage amplifies the downside. That's the core reason the Neocloud stocks have been so volatile. Let's hit the bear case head on. Skeptics like Jim Chanos argue that Neoclouds are not real tech companies at all. In their view, these firms are basically highly levered data center landlords, with AI branding and Nvidia stickers on the front door. They say Neoclouds deserve lower, infrastructure-style valuations, not high-growth multiples. And they worry the industry is overbuilding in response to a temporary AI mania. Hyperscalers have a safety net. If AI demand cools, they can repurpose capacity for storage, search, video, or internal workloads. Neoclouds don't have that same flexibility. Their revenue is tied almost entirely to AI demand and a small group of giant customers. The bear case in one line: you borrowed heavily to build AI-only infrastructure. If this boom slows, your equity gets crushed. Now the bull case looks at the same data and reaches the opposite conclusion. Bulls argue that we are still in the early innings of AI adoption. Every major company is rolling out AI features. Training new models and running inference at scale will keep pushing demand higher. They point out that many Neoclouds say their current GPU clusters are fully booked. An independent forecast suggests Neocloud revenue could grow at very high double-digit rates for the rest of this decade. In that world, being an AI landlord is actually powerful. Your mission is to secure land and power before everyone else, and you monetize that scarce capacity through long-term contracts. For the bulls, this recent sell-off isn't the end, it's a reset. Expectations come down, valuations cool off, and long-term investors finally get a chance to start positions without paying peak prices. Now let's talk companies, starting with CoreWeave. CoreWeave is the scale leader in the Neocloud space, a massive revenue backlog tied to customers like OpenAI and Meta, gigawatts of contracted power across multiple sites, and a deep partnership with Nvidia, including early access to new GPUs and even a deal where Nvidia can buy unused capacity for years. That's the bull story. If Nvidia remains dominant and AI demand stays strong, the biggest, best-connected Neocloud could be extremely valuable. But CoreWeave also comes with serious weight. It carries very large debt, running into the tens of billions. Interest costs are high, and current returns on capital look modest next to its cost of capital. When a third-party developer delayed a key site, CoreWeave had to cut guidance, and the stock was punished instantly. So CoreWeave is the high-scale, high-leverage Nvidia proxy. If everything goes right, the upside is huge. If the build-out or financing stumbles, equity feels it first. Next, we have Nebius. Nebius is based in Europe and has built its Neocloud business a bit differently. It started by serving smaller AI customers and startups, then landed large anchor contracts with companies like Microsoft and Meta. Financially, it looks like this. It has a smaller revenue base than CoreWeave, but it's growing extremely fast. It has less debt and, at least for now, a more conservative balance sheet. Because of that, the market values it at a higher multiple of sales. But it isn't risk-free. It also relies on partners to build data centers, and there are already scheduled pressures on some big projects. Nebius is effectively the cleaner balance sheet, higher valuation option. You're trading some financial safety for a richer price tag and very similar execution risks. Finally, let's look at IREN. IREN started as an Australian Bitcoin miner, but today its strategy is all about renewable-powered data centers. It builds and runs many of its own sites, and it has secured large amounts of power capacity in attractive locations. The thesis here is that power and land may become the real bottlenecks in AI. GPUs are critical, but if you don't have power, you can't use them. IREN has signed a multi-billion-dollar AI cloud contract with Microsoft and is targeting multi-billion annualized AI cloud revenue over the next couple of years. But remember, today, AI cloud is still a small slice of its total business. It has to execute a huge pivot from miner to AI landlord at high speed. IREN is the power-first optionality play. If energy and land are the scarce resources and they execute well, the upside is big. If they miss timelines or economics are weaker than hoped, the downside shows up quickly. So after the Neocloud crash, who actually survives and thrives? Here's a simple framework. This is not financial advice, just a way to think about it. CoreWeave is the high-scale, high-debt Nvidia proxy. Biggest upside if everything goes right, biggest balance sheet risk if it doesn't. Nebius is the diversified customer, cleaner balance sheet option. You pay more per dollar of sales, but get a structure that looks a bit less aggressive. IREN is the power and land bet. If energy is the long-term bottleneck and they manage the pivot, it could be very interesting. All three are high beta, high execution risk plays on the AI cycle. If you believe AI demand will keep outrunning capacity for years, the Neocloud crash might be the opening chapter, not the ending. But whether you look at CoreWeave, Nebius, or IREN, remember, don't just chase the contracts. Always understand the debt, the build-out risk, and how the story looks if the cycle slows down. If this breakdown helped, consider subscribing so you don't miss the next deep dive into AI infrastructure and semiconductor investing.